Hey everybody, it's Larry Berman here. Options expiry Friday, just after 4 o'clock. Another interesting week for the markets. We continue to see the bleed in the broad equity markets globally and led by the large cap tech names, of course, in the US. Let's take a dive into the chart room and see if we learned anything new this week. First chart is the China Credit Impulse Index. So this is a measurement of stimulus in China. It's measured a bunch of different ways, but it's updated monthly and it's a year over year sort of percentage change. And in recent last couple months, it's ticked below zero. The interesting observation here is the degree of stimulus that we saw in past cycles. Was pretty regular pattern here, as you could see in China every few years. And so this cycle, can you argue it's mid-cycle, or can you argue this cycle was earlier than this cycle? You can see the distance apart here measured in years to be about 4, a little bit longer, but a little bit shorter. And so maybe it's mid-cycle, but maybe it isn't. We learned in recent months that the Chinese population is now shrinking, and it's going to be increasingly difficult. Every night this week, there was a headline out of China, difficulties in the housing markets and bankruptcies, and you had Evergrande file for Chapter 15 protection in the US. So you've got a big challenge here for the second biggest economy in the world, and it's just going to make it difficult. So let's contrast that with the Atlanta Fed GDP now in the last month or two. And we've seen it bolt off the charts. Not that this is the perfect forecaster of what GDP is likely to be. In fact, it isn't. It's got a huge variance to actual. Nevertheless, notable what we're seeing in terms of the extreme in the US here. So, here's the conundrum. You've got pockets of slowing, you've got pockets of strength, you've got Walmart and retailers coming out and saying consumers are getting defensive, they're trading down, they're buying more generics. It's clear what's happening under the surface. The biggest thing by far that's different in this cycle than any others, and we mentioned it in recent weeks, and that is very simply that the transmission of monetary policy is significantly delayed because in the last few years, the vast majority of Americans who had mortgages locked that in. There was also the delay of student loan payments. So all of a sudden, you had households getting richer on average, and they've been spending and spending and spending. That's a major difference this time. We are not going to see the impact of higher rates on people's mortgages like we have in past cycles, because this cycle is very, very different. Very few homeowners, unless they're absolutely forced to, are not going to sell their house and rebuy with a much more expensive new mortgage. In Canada, that wave is going to hit and crush a lot of Canadians who weren't ready for their mortgage rates. Now, the good news there, of course, is that banks were testing Canadians to be able to carry a higher mortgage versus when interest rates are extremely low over the last number of years. So that dynamic will hit Canada harder. But in the US, starting now, people who have been deferred on their student loans now have to pay it. Saw one study this week, it's estimated to be about $400 per household. So consumption, discretionary spending, going to be a challenge going forward. Walmart, Ross stores, they're already telling us they're seeing it. And, there's more to come in that direction. What's not going to change in the next year is the amount of treasury supply needed, QT, and of course, this week we hear from Jerome Powell and co. at Jackson Hole. And the key question is, what is that level of interest rates? So with that said, there's a lot of chatter this week about higher for longer in terms of a 5% long-term interest rate. And so when we go back historically, so post GFC, interest rates around the world and in the US came down significantly. So we had long-term rates trending down until COVID. Now we're back into that range. One of the narratives during this period of falling rates is that the multiple, the forward multiple, is justifiable to be higher because long-term duration financing costs have come down. If we look at median financing cost during the last multi-year expansion, again, coming out of the dot-com bubble and into the housing bubble, that period there, US 30-year bonds were trading in the low 4s to the mid 5s. One would argue if we're going to get any sort of term premium come back in the market, we're going to stick in that range for a few years until they're sure inflation is going to die. Of course, my buddy David Rosenberg would argue against me significantly on this fact, but that's okay. That's what makes markets. But if this is true and this is what we're going to hear higher for longer at a Jackson Hole, then what is the forward PE going to head back to? And so one would argue that it's going to be somewhere 2, 3, 4, 5 multiple points lower than it is today. So if we're earning $200 on the S&P and we're 4 multiple points lower, that's 800 S&P points more to go. That doesn't factor in a hard landing, a recession, a hit to earnings, etc. Trailing earnings in the bag, as we know, are a little over 220. Forward earnings priced in at around 215, 216 right now. And if we go down to 200, being conservative, 17 times earnings, 16 times earnings. Again, that historical multiple, if you're looking at a retest of the 2022 lows for financial markets as to where good value starts to develop. Is that all going to play out? Don't know the answer to that, folks. But stay tuned every week as we update you on our thoughts here. But certainly there's more to come for this correction. Without a doubt, 4,200 on the S&P 500 is likely going to provide pretty good support in the next month or so. But if earnings start to decay, that's when that key support starts to break. And then we start to look at 3,800, 3,900 range as support. And of course, if that doesn't hold, then we look at those 2022 lows. So lots to go between here and there. We should get good support in the next month or so around 4,200 for a bounce. Again, it's a bounce. It's not the beginning of a new bull. The soft landing scenario in my mind is not something the Fed is going to give that message this week. I could be wrong. Stay tuned next week where we would have already heard from the Fed and Jerome Powell as to what that message is and what we think it means for markets. So no bull and bear pick of the week, but we did get an email in this week, and I thought maybe once a week I would take the opportunity to answer a viewer email that I can't get to on BNN necessarily. And so the Split Share Corp. So these preferreds and commons. So there's a preferred version of this that pays a coupon where the NAV kind of sticks, is more sticky. And because of that, the common share version, which is DFN, that trades here in Canada, has 2-to-1 leverage in it. And so when you look at the holdings, you see that it's 200% exposed to the Canadian banks and Lifecos and a few other names in there. And that's why you get more volatility in something like this. And so the question is, do you want to step in front of this volatility, Bob, that asked the question? And while long-term, the levels that we're at now are attractive, I wouldn't step in front of that volatility just yet. I would wait to see what kind of bottom's going to play out. When it does, getting back into a holding like this is going to give you 2 times the bounce on the upside. This is a trading vehicle. It's not something that's ideally suited for buy and hold investors. Have a great week, everyone.